There is a phrase, an old piece of folk wisdom that has been passed down through generations, simple in its construction but profound in its implication. It is a warning, a mental model, and a complete investment philosophy wrapped in a single sentence. Never ask a barber if you need a haircut. The barber, a good person perhaps, a skilled craftsman even, has a vested interest in the answer being yes. His livelihood depends on activity. His compensation is tied to the snip of the scissors, not to the long-term health of your hair. This simple, undeniable conflict of interest is the invisible architecture behind one of the largest and most powerful industries on planet Earth, Wall Street. And the one man who understood this, who built a $100 billion fortress of wealth on the foundation of this single principle, is Warren Buffett. He didn't just understand it, he weaponized it. He saw the financial world not as a collaborative enterprise for mutual enrichment, but as a vast barbershop, filled with friendly, confident professionals, all holding sharp instruments, all paid for the act of cutting, rarely for the art of growing. The costly mistake this principle prevents is the slow, silent erosion of your life's savings. It is the financial death by 1,000 cuts, administered by the very people you pay to be your stewards. It's the 1% management fee, the 2% expense ratio, the trading commission, the surrender charge, the 12b-1 fee. They are the financial friction, the parasitic load that guarantees the house always wins, and that your journey to financial freedom is perpetually uphill, on a path paved with gravel and broken glass. But the transformation, the true promise of internalizing this idea, is monumental. It is the casting off of chains you never knew you were wearing. It is the transition from a passive passenger in your own financial life to the pilot. It is the realization that the most trustworthy, the most incentivized, the most dedicated financial advisor you will ever have is the person you see in the mirror every single morning. By understanding Buffett's deep skepticism of conflicted advice, you are not just learning a clever trick, you are fundamentally rewiring your relationship with money, reclaiming your power, and beginning the real work of building lasting wealth. This isn't just about saving on investment fees, it's about taking control of your destiny. This journey begins with the first and most critical pillar of Buffett's philosophy, mastering the superpower of understanding incentives. He looks at every business deal, every stock purchase, every human interaction through a single clarifying lens. How does the other person get paid? For Buffett, incentives aren't just part of the story, they are the entire story. They are the invisible currents that dictate the flow of every river of human endeavor. While the rest of the world is listening to the pitch, Buffett is studying the pay stub. This foundational understanding is the shield that has protected him from the siren song of Wall Street for over 70 years. It's the reason he could build a global empire from a small office in Omaha, Nebraska, far from the noise and the self-serving chatter of the financial capital of the world. He knew the barbers were in New York, and he chose to learn how to cut his own hair. To see this principle in its purest, most potent form, we have to travel back in time, not to a moment of high-stakes corporate raiding or a dramatic stock market crash, but to a quiet beginning in 1956. This is the foundational anecdote, the origin story of the Buffett empire, and it all revolves around a simple fee structure. At the age of 25, with $100,000 of his own money and about $105,000 raised from a handful of family and friends, 7 partners in total, he formed his first investment vehicle, Buffett Associates Limited. From the very outset, the structure of this partnership was a radical departure from the norms of wealth management. It was, in effect, a direct assault on the barbershop model. The typical money manager of the day, much like the typical financial advisor of today, charged a fee based on the amount of money they managed, the assets under management, or AUM. Whether the client's portfolio went up, down, or sideways, the manager got their cut. Their incentive was to gather assets, not necessarily to generate returns. Buffett saw the flaw in this with absolute clarity. It was a structure that rewarded salesmanship over skill. So he designed his own. The terms of the Buffett partnership were revolutionary in their fairness and alignment of incentives. First, there was a 6% annual hurdle rate. This meant that the partners had to earn at least a 6% return on their capital before Buffett saw a single dime in compensation. 6% was, at the time, the approximate return one could get from a risk-free government bond. Buffett's logic was simple and unassailable. Why should he be paid for producing a result that an investor could achieve on their own, with zero risk, just by buying a bond? He was only to be rewarded for performance, terms above this baseline. He was being paid for his skill, for alpha, not for the passive beta of the market. This concept alone would be considered heresy in most modern wealth management offices. Second, and even more critically, was the way he shared in the profits. After the 6% hurdle was cleared, Buffett would take 25% of the profits above that level. There was no flat management fee, no hidden costs. His compensation was tied directly, purely, and brutally to the results he delivered to his partners. If they had a bad year and the portfolio lost money, or even if it made less than 6%, Warren Buffett earned nothing. In fact, he would have to make up for that underperformance in subsequent years before he could get paid again. He ate his own cooking. He had skin in the game. His financial fate was lashed directly to that of his investors. He wasn't the barber charging for the haircut. He was the business partner who only got paid if the shared enterprise flourished. Think about the psychological power of this arrangement. When his partners would gather for their annual meetings, they never had to wonder if Warren was working in their best interest. They never had to question his motives when he recommended a course of action. The structure of his compensation guaranteed his loyalty. His self-interest and their self-interest were one and the same. The structure powered one of the greatest track records in financial history. From 1957 to 1969, the Buffett partnership delivered a compound annual return of 29.5%, absolutely crushing the Dow Jones Industrial Average, which averaged just 7.4% in the same period. A dollar invested with Buffett at the beginning would have grown far beyond what any Wall Street firm could have offered. He wasn't just beating the market, he was creating a new paradigm for ethical and effective investment management. He proved that you could build immense wealth not by shearing the sheep, but by cultivating the flock. This anecdote isn't just a historical curiosity, it is the blueprint. It is the living embodiment of his philosophy. Before he ever bought a share of Coca-Cola or American Express, his first and most important investment was in a system of perfect incentives. He built a machine where his success was a direct byproduct of the success of others, a concept utterly alien to the transaction-based world of traditional finance. The reason Buffett's incentive-first approach is so powerful is because it serves as a perfect antidote to one of the most pervasive and insidious psychological biases that plagues human decision-making: incentive-caused bias. This is the principle, most famously articulated by his partner Charlie Munger, that people will tend to believe and argue for whatever is in their own best interest. As Munger succinctly put it, "Show me the incentive and I will show you the outcome." This isn't necessarily a sign of moral corruption or conscious deceit. It's a deep-seated feature of our cognitive wiring. The human brain is a master rationalization machine. When our livelihood depends on a certain worldview, our brain will work tirelessly, often subconsciously, to find evidence that supports that view and to ignore or discredit any evidence that contradicts it. It's not that the barber is a liar. It's that his brain is wired to genuinely believe, with every fiber of his being, that your hair is just a little too long and could benefit from his professional touch. Consider the financial advisor who works for a large brokerage firm. A significant portion of their compensation often comes from commissions on the products they sell. They might have a quota to meet for selling a particular in-house mutual fund, or they might receive a higher commission for selling a complex structured product than for a simple, low-cost index fund. Now, this advisor might be a wonderful person who genuinely wants to help their clients achieve their goals of building wealth and reaching financial freedom. But their cognitive environment is a minefield of conflicting incentives. When they look at a client's portfolio, their brain is subconsciously nudged. The high-fee mutual fund suddenly appears to have a, quote, more experienced management team. The complex annuity, with its hefty commission, is framed as providing valuable downside protection. The incentive doesn't just influence their behavior, it shapes their reality. It changes what they perceive as good advice. They aren't lying to you, they are lying to themselves, and you are just bearing the financial consequences of their self-deception. This bias is amplified by another psychological tendency, the authority bias. We are conditioned from birth to trust experts and figures of authority. The doctor in the white coat, the lawyer with the fancy degree, the financial advisor in the sharp suit sitting in a mahogany-paneled office. Their credentials and their environment project an aura of competence and trustworthiness. When this person, this authority figure, tells you that a 1.5% annual fee is a small price to pay for their expert wealth management, your brain is predisposed to accept it. You don't question it, because you assume they know more than you do. You are outsourcing your thinking to an expert without ever auditing the incentive structure that governs that expert's advice. Buffett's genius is in his complete immunity to this bias. He doesn't see the suit or the office. He sees the commission structure. He doesn't hear the jargon-filled pitch. He hears the faint hum of a cash register. By ruthlessly focusing on the incentive, he cuts through the psychological fog of authority and salesmanship and sees the situation with cold, hard clarity. He understands that even the most brilliant minds can be led astray when their paycheck points them in a particular direction. This is why he trusts his own research, his own analysis, and his own simple, aligned partnership structure above the recommendations of an entire industry built on conflicted advice. So how do you, as a retail investor or an entrepreneur trying to manage your capital, apply this powerful mental model in your own life? How do you build a shield against incentive-caused bias? The answer is to create and execute a systematic conflict of interest audit for any financial advice you receive. This is the blueprint for becoming your own best advisor. It's a step-by-step process, not based on emotion or trust, but on verifiable facts. Step 1. Identify the species of your advisor. There are many titles in the financial world: financial planner, wealth manager, stockbroker, insurance agent, but they generally fall into two broad categories. The first is a broker, who operates under a, quote, suitability standard. This means they only have to recommend products that are suitable for you, not necessarily what is best for you. If two funds are suitable, but one pays them a 5% commission and the other pays 1%, they are legally permitted to sell you the more expensive one. The second and far rarer category is a registered investment advisor, or RIA, who is bound by a, quote, fiduciary standard. A fiduciary is legally and ethically required to act in your best interest at all times, placing your interests above their own. Your first question to any advisor should always be, are you a fiduciary, and will you put that in writing? If they hesitate, equivocate, or say they are a fiduciary, sometimes you should walk out the door. Step 2. Demand to see their compensation model in plain English. Don't accept vague answers like, I'm paid by my firm. You need to know exactly how they make money from their relationship with you. Ask for a written breakdown. Is it a flat fee for a financial plan? Is it an hourly rate? Is it a percentage of assets under management AUM? Or is it based on commissions from the products they sell? If it's AUM, you need to understand that their incentive is to gather as much of your money as possible. If it's commissions, you must assume that every recommendation is a sales pitch. A fee-only fiduciary who charges a flat or hourly rate is generally the most aligned with your interests, as their advice is untethered from any specific product. Step 3. Interrogate the products, not just the person. Once a recommendation is made, say for a specific mutual fund, your audit continues. You need to become an investment detective. Ask for the fund's prospectus. Don't be intimidated by the long, dense document. You are looking for a few key numbers. Find the expense ratio. This is the percentage of your investment that is taken out each year to cover the fund's operating costs, including the manager's salary. Anything over 0.5% should be viewed with extreme skepticism. Then, look for other fees. Are there loads, which are sales commissions charged when you buy front-end load or sell back-end load. Are there 12B1 fees, which are marketing fees disguised as operational costs? Your goal is to uncover the total, all-in cost of owning that investment. The higher the costs, the more likely it is that the product was designed to enrich the company selling it, not you. This process of DIY investing in your own due diligence is the key to building wealth. Step 4. Always compare the recommendation to the simple, low-cost alternative. For any proposed investment, ask yourself and the advisor, how is this demonstrably better than simply buying a low-cost S&P 500 index fund ETF? The burden of proof should be on the complex, expensive product. The advisor must be able to articulate, with data and clear logic, why their recommended strategy is likely to outperform the simple, cheap alternative, after all fees and taxes are accounted for. More often than not, they cannot. This simple question acts as a powerful clarifying agent, cutting through jargon and exposing the true value, or lack thereof, in most financial products. By running this 4-step audit, you are no longer a passive recipient of advice. You are an active, critical thinker, applying a Buffett-like lens to protect your own capital. You are moving from being a sheep in the barbershop to being the owner of the entire ranch. To truly appreciate the power of this approach, we must examine its opposite. We must walk the path of the 99%, the well-trodden road of the average investor who places their trust in the traditional financial system without question. This is the antithesis, the cautionary tale that plays out in millions of brokerage accounts across the country every single day. Our protagonist is a successful professional, a doctor, a lawyer, an entrepreneur. They are intelligent and accomplished in their own field, but they consider investing to be a complex, foreign language. They've accumulated a respectable nest egg, say $250,000, and decide it's time to get professional help. They see a commercial for a large, reputable wealth management firm, one with a household name and a century-long history, and they make an appointment. They walk into an impressive office and are greeted by a friendly, confident financial advisor. The advisor listens patiently to their goals: retirement, college for the kids, financial freedom. He nods understandingly. He then presents them with a beautifully bound portfolio proposal, filled with charts, graphs, and sophisticated-sounding terminology. He recommends a diversified asset allocation of several actively managed mutual funds, all proprietary to his firm. He points to their star managers and their proven track record. He explains that the 1.5% annual management fee is the price of admission for this level of professional oversight and expertise. It sounds reasonable. It sounds responsible. Our investor feels a sense of relief. They have handed over the complex task of managing their money to a professional. They have checked a major item off their life's to-do list. But what they haven't seen is the incentive structure lurking beneath the surface. The advisor received a bonus for bringing in a new client with over $250,000. The mutual funds he recommended are the most profitable for his firm, not necessarily the best performing. That 1.5% fee is just the beginning. The funds themselves have high expense ratios and high portfolio turnover, which generates hidden trading costs and tax inefficiencies. A year goes by. The market is up 10%. Our investor looks at their statement and sees their portfolio is up only 7%. They ask their advisor why. The advisor has a ready answer. We are positioned more conservatively to protect on the downside. We're focused on long-term portfolio growth. It sounds plausible. Another year passes. The market is down 5%. Their portfolio is down 7%. The explanation: the sectors we are in were hit particularly hard, but our research shows they are poised for a strong rebound. This continues for years. Their returns always seem to lag the simple market index they see quoted on the news. They are paying for active management for the promise of beating the market, but they are receiving active underperformance. The advisor, still friendly, might occasionally suggest rebalancing or tax loss harvesting, which involves selling some funds and buying others. Each transaction feels like productive activity, but it also generates commissions and fees. The investor is being churned, their capital slowly being siphoned off. They are the frog in the slowly boiling water, never noticing the danger until it's too late. After 2 decades, they look at their account and are shocked. They have paid tens, perhaps hundreds of thousands of dollars in fees, and their nest egg is significantly smaller than if they had simply bought a single low-cost index fund and never touched it. They followed the conventional wisdom. They trusted the expert. They walked into the barbershop and, for 20 years, were told they needed a trim every single month. And the entire time, their financial future was the thing being cut down to size. The financial connection here is not abstract. It is brutally, devastatingly mathematical. Let's quantify the direct impact of ignoring Buffett's foundational principle. Imagine 2 investors, both starting with $100,000 at age 35. Both want to achieve financial freedom by age 65. Let's assume the stock market delivers an average annual return of 8% over the next 30 years. Investor A is our path of the 99% protagonist. She goes to a traditional financial advisor and is placed in a portfolio of actively managed mutual funds with an all-in cost of 1.75% per year, including the advisor's fee and the fund's expense ratios. Investor B is our self-reliant, Buffett-inspired investor. She does her own research and puts her money into a simple, low-cost S&P 500 index fund with an expense ratio of 0.05%. She never touches it. For investor A, her net annual return is 8% minus 1.75%, which equals 6.25%. For investor B, her net annual return is 8% minus 0.05%, which equals 7.95%. It doesn't seem like a huge difference, just over 1.7 percentage points. But this is the insidious magic of compound growth working in reverse. After 30 years, investor A's $100,000, compounding at 6.25% per year, will grow to approximately $624,000. A respectable sum, to be sure. But now let's look at investor B. Her $100,000, compounding at 7.95% per year, will grow to approximately $1,003,000. That's over $1 million. The difference between the two outcomes is a staggering $379,000. That is the cost of the barbershop. It's a brand new house. It's a decade of comfortable retirement. It's a legacy for her children. And it vanished into the pockets of the financial industry, not through a scam or a market crash, but through the perfectly legal, everyday friction of investment fees. This isn't just about money. It's about the very possibility of achieving your financial goals. That $379,000 is the tangible, quantifiable result of understanding one single idea: incentives drive outcomes. By choosing a low-fee DIY investing strategy, investor B didn't just save money on fees, she harnessed the full, unadulterated power of compound growth for herself. The conflict of interest, when manifested on a balance sheet over a lifetime, is not a minor detail. It is the single biggest variable that determines whether you will build substantial wealth or merely enrich the people who manage your money. This is the direct financial connection, the mathematical proof that Buffett's skepticism isn't just a folksy saying, it is a multi-$100,000 piece of advice for every single retail investor. Once you have mastered the art of seeing incentives, the next pillar of Buffett's fee avoidance strategy becomes clear: a zealous devotion to simplicity. Wall Street, much like any guild of priests or magicians, derives its power from complexity. It creates intricate products with opaque inner workings and wraps them in a language of impenetrable jargon: derivatives, collateralized debt obligations, structured notes. This complexity serves 2 purposes. First, it creates an information asymmetry, making the average person feel unqualified to manage their own affairs, thus driving them into the arms of the experts. Second, and more importantly, every layer of complexity is a place to hide a fee. Buffett's entire career has been a rebellion against this manufactured complexity. He believes that the best ideas are simple ideas, and that a successful investment strategy should be explainable to a reasonably intelligent person in 5 minutes. The most powerful and public demonstration of this belief is the story of Buffett's famous 10-year bet. This wasn't just a casual wager. It was a grand public showdown, a battle for the very soul of investing, simplicity versus complexity, low-cost passivity versus high-cost activity. The foundational anecdote begins in 2007. Buffett made a public offer to bet any hedge fund manager $1 million that over a 10-year period, a simple, unmanaged, low-cost S&P 500 index fund would outperform their hand-picked portfolio of sophisticated hedge funds. It was a direct challenge to the entire premise of the high-fee wealth management industry. The industry's claim was that their brilliant managers, their complex strategies, and their access to exotic investments justified their exorbitant fees, typically a 2-and-20 structure, meaning a 2% annual management fee plus 20% of any profits. Buffett's counter-argument was devastatingly simple. Those very fees would act as an anchor, making it mathematically impossible for them to beat the market over the long run. For a long time, no one took the bet. Finally, an investment firm called Protégé Partners stepped up. They were not a single hedge fund, but a fund of funds. Their entire business was to identify the best and brightest hedge fund managers in the world and assemble them into a diversified portfolio for their wealthy clients. They were the experts. They selected 5 different funds of funds, which in turn invested in hundreds of different underlying hedge funds, representing thousands of the highest-paid minds in finance. The bet was on Protégé Partners and their army of financial wizards against a single, simple, Vanguard S&P 500 index fund. The stakes were $1 million, with the winnings going to charity. The 10-year period began on January 1, 2008, and would end on December 31, 2017. The timing couldn't have been more dramatic. The starting pistol fired just before the great financial crisis. In 2008, the market crashed. The S&P 500 index fund lost a staggering 37%. The hedge funds, with their ability to short the market and use complex hedging strategies, did better, losing only about 24%. In the early years, the wizards of Wall Street were winning. The proponents of complexity were crowing. They argued that this proved their value. They could protect capital in a downturn. But Buffett remained calm. He wasn't betting on a single year. He was betting on a decade. He knew that the math of fees was a relentless, grinding force. As the markets recovered, the story began to change. The index fund, with its minuscule costs, captured the full power of the market's rebound. The hedge funds, meanwhile, were being bled dry by their own fee structures. The layers of fees, the 2-and-20 at the individual fund level, plus another layer of fees at the Protégé Partners fund of funds level, were a brutal handicap. Year after year, the simple index fund pulled further and further ahead. By the 9th year, the outcome was so certain that Protégé Partners conceded defeat. The final results were shocking in their clarity. Over the 10-year period, the S&P 500 index fund delivered a compound annual return of 7.1%. The average return of the 5 funds of funds selected by Protégé Partners was a mere 2.2%. The simple, cheap, passive investment had not just won, it had annihilated the competition. A $1 million investment in the index fund would have grown to over $1.8 million. The same investment in the hedge funds would have grown to just over $1.2 million. The difference was the cost of complexity. Buffett had proven, on the world's stage, that for the vast majority of investors, the quest for market-beating alpha was a fool's errand that primarily enriched the managers, not the clients. The barbershop, with all its fancy tools and sophisticated techniques, had been thoroughly beaten by a simple pair of clippers at home. The psychological principle that makes Wall Street's complexity so seductive is known as the illusion of complexity, or sometimes the expert problem. This is a cognitive bias where we instinctively assume that complex problems must require complex solutions. When faced with a daunting challenge like securing our financial future, our brain finds comfort in intricate strategies and the pronouncements of experts who speak in a specialized language. We see a chart with 15 different technical indicators and assume it must be more powerful than a simple buy and hold strategy. We hear about alpha-driven satellite positions and risk-parity asset allocation, and feel that we are getting access to a secret, superior form of knowledge. This deference to complexity is deeply rooted. In ancient times, it was the shaman with his secret chants and elaborate rituals. Today, it's the hedge fund manager with his proprietary algorithms and Bloomberg terminals. The financial industry masterfully exploits this bias. They understand that complexity is a moat that protects their business model. If investing were widely understood to be simple, there would be no justification for their high fees. So they have a powerful incentive to make it seem as complicated and intimidating as possible. They publish dense market reports filled with economic forecasts that are no better than guesswork. They create products like indexed annuities, which are so convoluted that even the brokers selling them often don't fully understand how they work. They use jargon as a weapon, creating a linguistic barrier between themselves and their clients. This all serves to reinforce the message: this is too complicated for you. You need us. And our expertise doesn't come cheap. Buffett's mind works in the opposite direction. He is a master of what is known as inversion. Instead of asking, what complex strategy can I use to beat the market? He asks, what are the simple, avoidable mistakes that cause most investors to fail? And the number one mistake is paying for complexity that doesn't add value. He understands that in many domains, especially long-term investing, simplicity is the ultimate sophistication. It's robust, it's transparent, it's low cost. By choosing a simple strategy, like buying and holding a broad market index fund, you are not being naive, you are being disciplined. You are consciously choosing to sidestep the psychological trap of complexity. You are refusing to pay a premium for the illusion of expertise. You are acknowledging that the secret to building wealth isn't a secret at all. It's owning a piece of the broad economy and letting the power of compound growth work for you with minimal friction. This embrace of radical simplicity is what allows him to tune out the noise, ignore the experts, and avoid the debilitating fees that are a direct consequence of the complexity trap. To translate this pillar into a practical tool, you can create what I call the one-page portfolio plan. This is the blueprint for harnessing the power of simplicity in your own financial life. It's an exercise designed to bring clarity and focus, to transform investing from a source of anxiety and confusion into a straightforward, manageable process. The goal is to distill your entire financial strategy onto a single sheet of paper. If it doesn't fit on one page, it's too complicated. Step 1. Define your destination. At the top of the page, write down your primary financial goal in a single, clear sentence. This is not the place for vague aspirations like get rich. Be specific. For example, to accumulate $1.5 million in my investment accounts by age 60 to fund a comfortable retirement. Or to grow this portfolio to $200,000 in the next 10 years to provide a down payment for a house. This sentence is your North Star. Every subsequent decision must serve this specific objective. Step 2. Set your asset allocation. This is the most important decision you will make as an investor. Asset allocation simply means deciding how much of your portfolio you will put into stocks for growth, and how much into bonds for stability. For most people with a long time horizon, a simple allocation like 80% stocks and 20% bonds, or even 90/10, is a perfectly sound strategy. You don't need 17 different asset classes. For your stocks, you can choose a single, globally diversified, low-cost stock market ETF. For your bonds, a single total bond market ETF. On your page, write it down. Asset allocation, 80% in total world stock market ETF, ticker symbol. 20% in total bond market ETF, ticker symbol. Step 3. Define your contribution strategy. How are you going to fuel this plan? Be specific and automate it. Write down: I will automatically invest $1,000 per month from my checking account on the first of every month, allocated according to my 80-20 strategy. Automation is the key to removing emotion and effort from the process. You are putting your wealth building on autopilot. Step 4. State your rules of engagement. This is where you pre-commit to good behavior and protect yourself from your own worst instincts. Your rules should be simple and absolute. For example, 1. I will not sell my investments because of a scary headline or a market downturn. 2. I will not try to time the market by jumping in and out. 3. I will only check my portfolio balance once per quarter. 4. I will rebalance my portfolio back to my 80-20 target once per year on my birthday. That's it. Your entire plan, your goal, your investments, your contribution schedule, and your behavioral rules, all on one page. This document is your shield against complexity. When a financial advisor tries to sell you a complex, high-fee product, you can hold up your one-page plan and ask, how does this fit into my simple, stated strategy? When the market is crashing and your gut tells you to sell everything, you can look at your pre-written rules and hold the course. This one-page portfolio plan is the ultimate tool for DIY investing. It provides the clarity, discipline, and simplicity needed to tune out the noise, avoid unnecessary fees, and focus on the handful of factors that actually drive long-term portfolio growth. The antithesis to this gospel of simplicity is the path taken by the investor who is seduced by the allure of the complex. This is the person who believes that the secret to beating the market must be hidden in some esoteric strategy or exotic product. They see simplicity as unsophisticated, the sign of a novice. They are the perfect customer for the Wall Street barbershop, which has a whole menu of expensive and confusing haircuts waiting for them. Their journey into financial ruin often begins with a sense of dissatisfaction. Their simple index funds are just tracking the market, which feels boring. They want an edge. They find a financial advisor who speaks their language. This advisor doesn't talk about simple ETFs. He talks about tactical asset allocation and alternative investments. He introduces our investor to the world of non-traded real estate investment trusts, REITs. He pitches it as a way to get the returns of real estate without the hassle of being a landlord, with a tempting high-yield dividend. What he downplays is the massive, often hidden, upfront commission, sometimes as high as 10%, the complete lack of liquidity, you might not be able to get your money out for years, and the opaque valuation of the underlying assets. Our investor buys in, feeling they now have a sophisticated real estate component in their portfolio. Next, the advisor suggests a structured note. This is a complex derivative product created by an investment bank, offering, quote, downside protection with upside potential. The marketing materials are filled with complex payout scenarios involving buffers, caps, and participation rates. It feels safe and clever. Our investor doesn't fully understand how it works, but they trust the advisor. They don't realize that the downside protection often comes at the cost of capping their potential gains, and that the product is packed with hidden fees and a fat profit margin for the issuing bank. Their portfolio is no longer a clear, simple collection of stocks and bonds. It's becoming a black box, a Frankenstein's monster of illiquid, expensive, and opaque products. They might even get lured into private equity funds for accredited investors, feeling a sense of exclusivity, not realizing the 2 and 20 fee structure and long lockup periods make it a near certainty they will underperform public markets. Years pass. The investor looks at their statement and has no idea what is truly driving their returns, or lack thereof. They own a hodgepodge of products, each with its own Byzantine fee structure. When one of them performs poorly, the advisor has a ready excuse, or simply sells it and moves them into a new, equally complex product, generating another round of commissions. They are trapped in a cycle of complexity, forever chasing the next sophisticated strategy, their portfolio being constantly churned and eroded by fees. They have paid a king's ransom for the feeling of being an insider, But the only thing they have successfully achieved is the dramatic underperformance of a simple, boring, low-cost index fund. They scorned simplicity, and in doing so they sacrificed their financial future on the altar of complexity. The direct financial connection between simplicity and wealth is stark and quantifiable, and it is best illustrated by dissecting the fee structure of the products our antithetical investor was sold. Let's start with that non-traded REIT. A typical 7 to 10% upfront commission and fee load means that on a $50,000 investment, up to $5,000 is gone on day one. Your investment has to climb by more than 10% just for you to break even. Now consider the hedge fund or private equity fund with its classic 2 and 20 fee structure. The 2% management fee is a constant drag, year after year, regardless of performance. But the 20% performance fee, the carry, is the real killer. It's usually subject to a high watermark, meaning the manager only gets paid on new profits. However, it creates a heads I win, tails you lose scenario. If the manager has a great year and is up 30%, they take their 20% cut of those gains. If the next year they lose 20%, you, the investor, bear the full brunt of that loss. They share in the upside, but not the downside. This asymmetric payoff structure makes it incredibly difficult for the end investor to compound wealth effectively. Let's put numbers to it. Compare a simple, low-cost index fund ETF with an annual expense ratio of 0.04% to a typical fund of hedge funds with a layered fee structure that amounts to, say, a 3% annual management fee and a 20% performance fee. Let's assume both underlying markets return 10% in a given year. The index fund investor keeps 9.96% of that return. The hedge fund investor first pays the 3% management fee, bringing the return down to 7%. Then, the manager takes 20% of that 7% profit, which is another 1.4%. The investor's final net return is just 5.6%. In a year when the market made 10%, the person who chose complexity received barely half of the return. Now, compound that difference over 20 or 30 years. The gap becomes a chasm. The index fund investor's capital gains are allowed to compound with minimal friction, leading to exponential portfolio growth. The hedge fund investor's capital is in a constant battle against the headwinds of fees, making true financial freedom a distant, perhaps unattainable dream. Simplicity isn't just an aesthetic preference, it is a mathematical imperative for anyone serious about building wealth. It is the conscious decision to keep the vast majority of your returns for yourself, rather than sharing them with the barbers of Wall Street. Having understood the importance of incentives and simplicity, we arrive at the third pillar, which is the logical consequence of the first two, the unwavering fortress of self-reliance. If you cannot trust the advice of those with conflicting incentives, and if the optimal strategy is simple enough to be understood, then the only rational conclusion is that you must take ownership of your own financial education and decision-making. The only way to permanently avoid the barber's self-serving advice is to learn how to look in the mirror and assess your own hair. Buffett is the epitome of this principle. He is perhaps the most voracious reader in the history of business, famously spending up to 80% of his day reading and thinking. He doesn't rely on Wall Street reports or analyst ratings. He relies on his own deep, fundamental analysis of businesses. He trusts his own homework above all else. The foundational anecdote that best illustrates this pillar of radical self-reliance is the story of his investment in American Express during the infamous salad oil scandal of 1963. This was a moment of crisis, a true trial by fire that tested his courage and his methodology. A company in New Jersey called Allied Crude Vegetable Oil, run by a charismatic fraudster named Tino DeAngelis, had perpetrated a massive scam. Allied had borrowed enormous sums of money from various banks, including American Express's warehousing subsidiary, using its inventory of salad oil as collateral. The problem was, the inventory was a phantom. The company's giant storage tanks were mostly filled with water, with only a thin layer of oil floating on top to fool inspectors. When the fraud was discovered, Allied collapsed, and American Express was on the hook for potentially catastrophic losses, estimated at the time to be around $60 million, a huge sum that threatened to wipe out the company's net worth. Wall Street panicked. The consensus was overwhelming. American Express was doomed. The stock price plummeted by nearly 50%. The barbers were all screaming, "Sell!" The air was thick with fear and uncertainty. This is precisely the kind of environment where most investors outsource their thinking to the experts and follow the herd off a cliff. But Warren Buffett did the opposite. He didn't listen to the noise. He decided to do his own research, to become his own expert. He knew that the real question was not about the size of the loss, but about the enduring strength of American Express's core businesses, their credit cards and travelers' checks. Did the salad oil scandal damage the fundamental trust that people had in the American Express brand? So he got out of his office. He began his own on-the-ground scuttlebutt investigation. He went to restaurants and stores in Omaha, observing customers. Were they still using their American Express cards? He talked to cashiers and managers, asking them if they were seeing any drop-off in Amex usage. He went to local banks and spoke with tellers, asking if people were still buying and cashing American Express travelers' checks. He even went to his competitors, talking to people in the travel and credit industries, to get their take on the situation. The feedback he got was unanimous. The scandal was a Wall Street story, a financial drama. But for the average person, for the merchants and the customers, nothing had changed. The trust in that little green card and those familiar travelers' checks was unshaken. The brand's competitive moat was intact. Armed with this first-hand, proprietary research, Buffett gained immense conviction. He concluded that Wall Street's panic was a massive overreaction. He saw a world-class business trading at a ridiculous price because of a temporary, albeit serious, problem. He then made one of the boldest moves of his early career. He invested 40% of his partnership's entire capital into American Express stock. It was a huge, concentrated bet, born not from a hot tip or a Wall Street report, but from his own diligent, independent work. The outcome was spectacular. As the company absorbed the losses and the market realized the underlying business was sound, the stock price soared. The investment generated enormous returns for his partners and cemented his reputation as a brilliant contrarian investor. This story is the ultimate testament to the power of DIY investing. It proves that the greatest informational advantage you can have is not access to some secret Wall Street algorithm, but the willingness to do your own fundamental research and the courage to trust your own conclusions, even when the rest of the world is telling you you're wrong. The psychological principle that Buffett masterfully navigates here is the interplay between the Dunning-Kruger effect and the overconfidence bias, specifically avoiding both in himself while recognizing them in others. The Dunning-Kruger effect is a cognitive bias where people with low ability at a task tend to overestimate their own ability. In investing, this manifests as the novice retail investor who, after a few lucky trades, believes they are a stock-picking genius. They become overconfident and take on excessive risk, often leading to disaster. Buffett avoids this by staying rigorously within what he calls his circle of competence. He is famously humble about what he doesn't know. He has openly admitted he doesn't understand tech businesses well, which is why he avoided them for most of his career. He doesn't pretend to be an expert in every industry. This intellectual honesty is a core part of his self-reliant framework. He knows precisely where the boundaries of his knowledge lie, and he rarely strays beyond them. Conversely, he recognizes that the financial industry is rife with overconfidence bias. Wall Street analysts and economists are paid to have an opinion on everything. They produce endless forecasts about interest rates, market direction, and quarterly earnings, despite overwhelming evidence that these predictions are no better than random chance. They project an aura of certainty and expertise that is entirely unwarranted. The average person feeling their own incompetence in the face of this expert consensus falls into a trap. They feel they must outsource their thinking, believing that these confident professionals must know something they don't. This is the psychological vulnerability that leads to herd behavior, buying at the top when everyone is euphoric and selling at the bottom when everyone is panicking. Buffett's self-reliance is the antidote. His process of deep, independent study is designed to build earned confidence, which is the polar opposite of the shallow overconfidence of the novice trader or the performative confidence of the Wall Street analyst. Earned confidence comes from doing the hard work, reading the annual reports, understanding the business model, studying the competitive landscape, and calculating the intrinsic value. When you have done this work, your conviction is not based on the opinions of others, but on a solid foundation of your own knowledge. This allows you to act rationally when others are acting emotionally. It gives you the strength to buy when others are fearful, as he did with American Express, and to be fearful when others are greedy. True self-reliance in investing is not about knowing everything. It's about knowing what you know, knowing what you don't know, and having the discipline to do the hard work required to build genuine, earned confidence within your circle of competence. So how can you begin to build this fortress of self-reliance? The blueprint is to adopt an investor's daily ritual, a set of habits inspired by Buffett's own practices, designed to slowly and steadily build your knowledge and your circle of competence. This isn't about becoming a full-time analyst overnight. It's about a consistent, long-term commitment to your own financial education. First, change your information diet. The vast majority of financial media is noise designed to provoke an emotional response and encourage activity. Stop watching the market news channels that scream about daily price movements. Stop reading articles with headlines like, "5 stocks to buy now." Instead, dedicate 30 minutes each day to reading primary source materials. The single most valuable document is a company's annual report, especially the chairman's letter to shareholders. Start with companies you already understand as a consumer. The company that makes your favorite drink, your phone, or your running shoes. In his letters, Buffett himself provides a master class in clear business thinking. Reading the last 20 years of Berkshire Hathaway's annual letters is the equivalent of getting an MBA in intelligent investing. Second, start a business journal. When you read about a company, don't just passively consume the information. Actively engage with it. In your journal, for each company you study, try to answer a few simple questions in your own words. 1. How does this business make money? Be specific. 2. What is its competitive advantage, its moat? Why do customers choose them over their rivals? Is it a powerful brand, a network effect, a low-cost production process? 3. Would I be comfortable owning this entire business for the next 10 years if the stock market closed tomorrow? This question forces you to think like a business owner, not a stock trader. Third, practice the art of valuation. You don't need a complex discounted cash flow model to start. A simple approach is to look at a company's earnings per share, EPS, over the last 10 years. Is it a consistent, growing number? Then look at the price-to-earnings (PE) ratio. Is it reasonable compared to the company's own history and its growth prospects? The goal isn't to find the precise intrinsic value down to the penny, but to develop a general sense of whether a business is cheap, fair, or expensive. This simple practice builds your valuation muscle over time. This daily ritual, reading primary sources, journaling your analysis, and practicing simple valuation, is the workout regimen for the self-reliant investor. It's not glamorous. It's not a get-rich-quick scheme. But over months and years, it will compound your knowledge just as your investments compound your capital. You will slowly but surely build your own circle of competence, develop your own judgment, and earn the confidence needed to make your own decisions, rendering the conflicted advice of the barbershop completely irrelevant. The antithesis of the self-reliant investor is the hot tip chaser. This individual represents the vast majority of market participants who treat investing not as the disciplined ownership of businesses, but as a form of gambling or entertainment. Their financial strategy is not guided by research or a coherent philosophy, but but by the chaotic whirlwind of market noise. They are the person who overhears a stock tip at a party and buys it the next morning without a second thought. They see a stock soaring on a Reddit forum and jump in, driven by a fear of missing out, FOMO. They watch a charismatic CEO on television and become convinced that his new technology will change the world, so they pile into the stock at its peak. The hot tip chaser's portfolio is a chaotic graveyard of past fads and broken stories. They own a piece of a cannabis company they bought at the height of the legalization hype, now down 90%. They have a few shares of a meme stock they bought near the top of a short squeeze, hoping for a quick double. They bought an obscure biotech firm based on a rumor of a miracle drug, only to see it crash when the clinical trials failed. They are always reacting, never anticipating. Their decision-making is purely emotional, driven by the twin engines of greed and fear. They have no circle of competence, no valuation discipline, and no long-term plan. Their only research is a quick glance at a stock chart or a 5-minute read of a sensationalist news article. This approach is not just ineffective, it is actively destructive to building wealth. The hot tip chaser is perpetually buying high during periods of peak excitement and selling low during periods of peak panic. They pay far more in trading commissions because of their constant activity. Their short-term holding periods mean that any rare profits they do make are taxed at the highest possible rate as short-term capital gains. They are the perfect client for a commission-based stockbroker who can feed their addiction to action by constantly pitching them new ideas and stories. They are, in essence, volunteering to be the sheep for Wall Street to shear. Their journey is one of frustration, anxiety, and, ultimately, significant capital loss. They have abdicated the responsibility of thinking for themselves, and the price they pay for that abdication is their financial future. The direct financial connection here is the crucial concept of the margin of safety, a term coined by Buffett's mentor, Benjamin Graham. A margin of safety is the difference between the intrinsic value of a business and the price you pay for its stock. It is the single most important principle for the preservation of capital. By doing your own diligent, self-reliant research, you can develop a reasonable estimate of what a business is actually worth. For example, your research might indicate that a particular company is worth $100 per share. A margin of safety means you will only buy that stock when it is trading at a significant discount to that value, say at $60 or $70. This margin of safety provides a buffer against errors in judgment, bad luck, or the inevitable downturns in the broader economy. If your valuation was slightly off and the business is only worth $90, you still have a buffer. If the company has an unexpectedly bad year, the low purchase price protects your principal. It is the financial equivalent of building a bridge that can hold 30,000 pounds, but only ever driving a 10,000-pound truck over it. The hot tip chaser has no margin of safety. Because they do no valuation work, they have no idea what a business is worth. They are simply buying a stock ticker at a price. More often than not, the hot tip they are acting on comes when a stock is already popular and hyped, meaning its price is likely at or above its intrinsic value. They are buying at a price of $120, what might only be worth $100. They have a negative margin of safety. Any small piece of bad news, any market hiccup can lead to a permanent loss of capital. Let's quantify this. Imagine two investors. Investor A, the self-reliant one, buys a stock with a 40% margin of safety, paying $60 for what she believes is a $100 value. Investor B, the hot tip chaser, buys the same stock at the peak of its hype for $120. A mild recession hits, and the company's intrinsic value temporarily drops by 20% to $80. Investor A's stock might fall from $60 to $50, a paper loss, but her capital is largely intact because her purchase price was so low. Investor B's stock plummets from $120 to $50. She has suffered a catastrophic 58% loss of capital. Self-reliance isn't just an intellectual exercise, it is a risk management strategy. The hard work of independent research translates directly into the ability to purchase assets with a margin of safety, which is the ultimate defense against the fees of bad advice and the permanent destruction of your hard-earned money. It is the structural engineering behind a portfolio built for long-term survival and growth. This leads us to the fourth pillar of Buffett's philosophy, a principle that is so counterintuitive and so antithetical to the entire culture of Wall Street that it almost sounds like a joke: the profound virtue of inactivity. The financial industry is a whirlwind of ceaseless motion. The tickers flash, the news breaks, the analysts recommend, the traders trade. The entire business model is predicated on activity. Because activity generates fees and commissions, Buffett's approach is the polar opposite. He has famously said, "Our favorite holding period is forever, and lethargy bordering on sloth remains the cornerstone of our investment style." He understands that the constant urge to do something is one of the greatest enemies of the individual investor. There is no better foundational anecdote to illustrate this pillar than the story of See's Candies. It is not a tale of a dramatic stock market play, but a quiet story of a half-century of patient ownership. In 1972, Warren Buffett and Charlie Munger, through their company Blue Chip Stamps, purchased See's Candies for $25 million. At the time, See's was a well-regarded but geographically limited candy company based in California. The asking price was 3 times the company's book value, and Buffett, still deeply rooted in the deep value principles of his mentor Ben Graham, almost walked away from the deal. It was Charlie Munger who pushed him to pay up for a high-quality business, a pivotal moment in Buffett's evolution as an investor. What happened after they bought See's is the crucial part of the story. Almost nothing. There were no brilliant financial engineering schemes. There was no aggressive, debt-fueled expansion across the country. They did not try to synergize it with their other businesses or optimize its capital structure. They recognized that they had purchased a wonderful business with a powerful brand, a loyal customer base, and an honest and competent management team. So they did the smartest thing they could possibly do. They got out of the way. They let the managers run the business, and they let the brand work its magic. For the next 5 decades, Berkshire Hathaway has held See's Candies. They have never been tempted to sell it to, quote, lock-in profits. They have never entertained an offer from a private equity firm. They have never felt the need to reallocate that capital to a hotter, faster-growing industry. They simply sat and held. And what were the results of this disciplined inactivity? That little $25 million investment has since returned more than $2 billion in pre-tax profits to Berkshire Hathaway. It has been a gusher of cash, funding Berkshire's other investments in insurance, railroads, and technology. It required virtually no additional capital investment, making it an astonishingly efficient cash-generating machine. The story of See's Candies is the ultimate rebuke to the hyperactive Wall Street mindset. It is proof that often the most profitable move an investor can make is no move at all. It is a masterclass in the power of buying a great business at a fair price and then letting the miracle of compounding do its work, uninterrupted by the frictional costs and intellectual turmoil of constant activity. The underlying psychological principle that drives the destructive need for action is called action bias. This is our innate cognitive tendency to favor action over inaction, even when there is no rational evidence that acting will lead to a better outcome. In many areas of life, this bias serves us well. If a tiger is chasing you, it is better to run than to stand still. But in the world of long-term investing, action bias is a deadly poison. The financial media is a giant, 24/7 engine designed to trigger your action bias. Every market wiggle is framed as a crisis or an opportunity. Every earnings report is a reason to buy or sell. The constant stream of information creates a feeling of urgency, a sense that you must do something right now or risk being left behind. The financial industry profits directly from your action bias. Your stockbroker doesn't make money when you sit on your hands for 10 years. He makes money when you trade. Your mutual fund company loves it when you panic sell one fund and buy another, as this asset gathering is their core business. The entire ecosystem is designed to provoke you into action, because your action is their revenue. Buffett's philosophy of lethargy bordering on sloth is a conscious and deliberate system for overriding this deep-seated psychological urge. He understands that every transaction has a cost, both visible, commissions, taxes, and invisible, the opportunity cost of interrupting compounding. He knows that the portfolio of a truly great business is like a bar of soap. The more you handle it, the smaller it gets. By adopting an attitude of extreme patience and inactivity, he starves the Wall Street fee machine. He also insulates himself from the emotional roller coaster of the market. He doesn't need to react to the news because he is not a speculator on stock prices. He is a part owner of businesses. And as a business owner, he knows that great businesses are not built or destroyed in a single quarter or a single year. They are built over decades. This long-term perspective is what allows him to sit calmly through market crashes and speculative bubbles, holding his wonderful businesses like See's candies, while the rest of the world is frantically churning their portfolios into oblivion, all in service of their deeply flawed and deeply human action bias. How can you, as an individual investor, instill this virtue of inactivity into your own process? The blueprint is one of Buffett's most famous mental models, the 20-slot punch card. This is a powerful thought experiment designed to force discipline and long-term thinking. Imagine that when you are born, you are given a punch card with only 20 punch slots on it. Each time you make an investment decision in your entire life, buying a stock or a fund, you have to punch one of those slots. Once you have used up all 20 punches, you can't make any more investments. This mental model dramatically raises the stakes for every decision. You would not waste a precious punch on a speculative hot tip from a friend. You would not burn a slot on a company you don't fully understand. You would not use a punch to try and time the market. Instead, you would treat each decision with the gravity it deserves. You would do deep, thorough research. You would wait patiently for a truly outstanding opportunity, a business so good and a price so attractive that you are willing to commit one of your irreplaceable slots to it. And once you have made the investment and punched the card, you would be far more inclined to hold it for the long term, because selling it to buy something else would require using another precious slot. To apply this blueprint, you can create a physical or digital representation of your own 20-slot punch card. Before you make any new investment, force yourself to go through a formal process. Write down the investment thesis on a single page. Articulate exactly why you believe this is one of the 20 best ideas you will have in your lifetime. If you can't make a compelling case, you don't make the investment. This simple exercise acts as a powerful brake on your action bias. It transforms you from a hyperactive trader into a patient, selective business owner. It forces you to focus on the quality and long-term prospects of your investments, rather than the short-term noise of the market. This single mental model can save you a fortune in unnecessary trading costs, taxes, and, most importantly, the catastrophic errors that come from making too many decisions with too little thought. It is the operating system for a lifetime of successful inactive investing. The antithesis of the patient inactive investor is the tinkerer. This is the person who cannot leave their portfolio alone. They are constantly fiddling with it, adjusting their asset allocation, trimming their winners, and adding to their losers. They see their portfolio not as a garden to be cultivated over decades, but as a complex machine that requires constant fine-tuning. The tinkerer reads an article that says international stocks are poised to outperform, so they sell some of their U.S. stock fund to buy an emerging markets fund. A month later, they hear a pundit on TV predict that interest rates are going to rise, so they sell their bond fund and move to cash. Then they see that technology stocks have had a great run, so they sell some of their boring value stocks to chase the momentum in tech. Their portfolio is in a state of perpetual motion. They are always rebalancing, always chasing the latest trend, always reacting to the latest news cycle. They believe they are being sophisticated and proactive, engaging in advanced portfolio management, but what they are actually doing is destroying their own returns. Every time they make a trade, they incur a transaction cost. Every time they sell a winning position, they trigger a taxable event, turning unrealized capital gains into a realized tax liability. They are constantly interrupting the process of compounding. Their portfolio never gets the chance to build long-term momentum because they are always uprooting the plants to see if the roots are growing. The tinkerer is the dream client of the financial industry. They generate a steady stream of commissions for their broker. Their constant movement between funds is a boon to the mutual fund companies. They are the embodiment of the action bias, and they pay a heavy price for it. Over the long run, their frantic activity ensures that their returns will be mediocre at best. They will find that after years of diligent tinkering, their portfolio has grown far less than that of a neighbor who simply bought a balanced index fund and then forgot about it for a decade. The tinkerer, in their quest to optimize everything, has optimized for nothing but fees, taxes, and frustration. This brings us to the direct financial connection, where we quantify the devastating impact of hyperactivity. The primary destroyers of long-term returns are what Buffett calls the twin killers: fees and taxes. Every unnecessary trade you make feeds these two killers. Let's create a simple scenario. Investor A is our patient, inactive owner. She buys $100,000 worth of a single great company's stock and holds it for 20 years. The stock compounds at 12% per year. At the end of 20 years, her initial investment is worth approximately $964,629. She has never sold, so she has paid zero in capital gains taxes along the way. If she sells at the end, she will pay a long-term capital gains tax on her profit. Investor B is the tinkerer. She starts with the same $100,000 in the same stock, but she's more active. At the end of every 2 years, she sells her position to lock in gains and then buys another, similar company, hoping to catch the next wave. We will assume she is a brilliant trader and manages to earn the same 12% annual return. However, every 2 years, she sells and realizes her gains. Let's say her profit is taxed at a combined federal and state long-term capital gains rate of 20%. After the first 2 years, her $100,000 has grown to $125,440. She has a profit of $25,440. She sells, pays 20% tax, $5,088 on the profit, and reinvests the remaining $120,352. She repeats this process every 2 years for 20 years. Because she is constantly paying taxes, the amount of capital she has working for her is continuously being reduced. At the end of the 20-year period, after all the selling and rebuying, her final portfolio value will be approximately $685,345. By being active, by tinkering, by trying to be clever, she has ended up with $279,284 less than the investor who did nothing. That is the staggering quantifiable cost of unnecessary activity. It is the direct financial reward for embracing the virtue of inactivity. The simple act of sitting still, of letting your assets compound uninterrupted by taxes and fees, is one of the most powerful wealth-building strategies in existence. Finally, we arrive at the fifth and culminating pillar. This is where we elevate the thesis from a mere warning against bad advice to a positive, aspirational principle. It is the idea of adopting the fiduciary standard as a personal commandment. A true fiduciary is someone who is legally and ethically bound to act in the best interest of another party. Buffett doesn't just seek out fiduciaries, he internalizes this duty. He acts as the ultimate fiduciary for his own capital and for the capital of his shareholders. He treats his responsibility with a level of intellectual honesty, discipline, and long-term thinking that the financial industry rarely offers its clients. This is the final step: to stop looking for a trustworthy barber and to become a master stylist for yourself, guided by an unwavering duty to your own future well-being. The foundational anecdote for this pillar is one of the most remarkable and least understood events in Buffett's career: the decision to dissolve the Buffett partnership in 1969. This was not a story of failure, but of epic success. As we discussed earlier, the partnership had delivered breathtaking returns for over a decade. His partners had become rich. Buffett himself was a multimillionaire. He was at the absolute top of his game. And yet, at this peak, he chose to walk away. He sent a letter to his partners announcing that he was closing the fund and returning their capital. Why? The year was 1969, and the stock market was in the grip of a speculative frenzy. It was the go-go era. Stock prices had become unmoored from business fundamentals. Everyone was chasing hot concepts, and valuations were stretched to absurd levels. In this environment, Buffett felt he could no longer find investments that met his rigorous standards of value and safety. The pond had become too small, and the other fishermen were too manic. He wrote to his partners, "I am not attuned to this market environment, and I don't want to spoil a decent record by trying to play a game I don't understand." Think about the significance of this act. A modern-day fund manager in the same position would have done the exact opposite. They would have embraced the speculative mania, chasing the hot stocks to keep up with their benchmarks. They would have continued to collect their fat management fees, knowing that as long as the party kept going, the money would keep rolling in. To close a fund at the height of its success and voluntarily give up millions in future fees is an act almost unheard of in the financial world. But Buffett was operating under his own personal fiduciary standard. His primary duty was not to maximize his own income, it was to protect and grow his partners' capital. He knew that continuing to operate in that overvalued market would require him to lower his standards, to take on risks that he found unacceptable. And so, he chose the path of ultimate intellectual honesty. He told his partners that he could no longer do his job effectively and that their money would be better off elsewhere. He gave them their capital back, along with some shares in a textile company he had bought called Berkshire Hathaway. He acted as a true fiduciary, protecting his clients even from his own inability to find value. He put their interests so far ahead of his own that he was willing to shut down his entire business. This act of profound integrity, of placing principle above profit, is the ultimate expression of the fiduciary duty he had internalized as his own personal commandment. The psychological principles at play here are the powerful biases of the endowment effect and the commitment and consistency bias. The endowment effect is our tendency to overvalue something simply because we own it. An investor who buys a stock at $50 and sees it fall to $30 will often irrationally believe it's worth at least the $50 they paid, making it difficult to sell and admit a mistake. The commitment and consistency bias is our deep-seated need to be consistent with our past decisions and beliefs. A financial advisor who has publicly recommended a certain investment strategy will find it very difficult to reverse course, even in the face of new evidence, because doing so would be an admission of a prior error. Their ego and their reputation are on the line. These biases are what cause investors and advisors to hope a losing investment will turn around, to average down into a failing business, and to stick with a broken strategy long after it has proven ineffective. They become emotionally attached to their positions and their own narratives. Acting as your own fiduciary requires the psychological toughness to override these biases. It demands a form of radical intellectual honesty. It means being able to look at an investment you own and analyze it with the same cold, detached skepticism you would apply to a new idea. It means having the discipline to say, "I was wrong about this. The facts have changed, and my original thesis is no longer valid. I must sell and move on." Buffett's decision to dissolve the partnership in 1969 was a monumental act of overcoming commitment bias. He had committed his entire professional life to his value investing strategy, but he was intellectually honest enough to recognize that the strategy was not suited for that particular market environment. A lesser investor would have stubbornly stuck to his guns, or worse, changed his strategy to chase the speculation. Buffett's fiduciary commitment to his partners' capital was stronger than his ego's commitment to his own past methods. This is a level of psychological discipline that is incredibly rare. To truly act as your own fiduciary, you must cultivate this ability to detach your ego from your decisions and to ruthlessly reevaluate your own positions as if they belong to someone else. The practical blueprint for instilling this fiduciary discipline is a powerful decision-making tool popularized by the psychologist Gary Klein, known as the pre-mortem analysis. This is a method of proactive risk management that is used by high-stakes professionals, from surgeons to military commanders. For an investor, it is the ultimate tool for stress testing a decision before you commit your capital. The process is simple but profound. Before you make any significant investment, before you punch one of your 20 slots, you conduct a pre-mortem. Step 1. Gather your team, even if it's just you, and imagine you are in a meeting. Announce the following: "We are 1 year in the future. We have made this investment, and it has been an absolute disaster. It has failed spectacularly, and we have lost a significant amount of money. Our plan has gone completely wrong." Step 2. Each person now has 5 to 10 minutes to independently write down every possible reason they can think of for why it failed. This is crucial. You are not asking what might go wrong. You are stating that it has gone wrong and asking for the story of how it happened. This framing is a psychological trick that frees people from the natural optimism and confirmation bias that surrounds a new decision. It gives them permission to be critical and to look for flaws. Step 3. Go around the room and have each person read their list of reasons for the failure. Was it a new competitor we didn't see coming? Did the company's key product become obsolete? Was the management team dishonest? Was our initial valuation based on a flawed assumption? Did a change in regulations destroy the company's profitability? Create a master list of all these potential failure points. Step 4. Now, with this comprehensive list of risks and potential points of failure in hand, you can reevaluate the original investment decision. Can these risks be mitigated? Are there any deal breakers on the list that make the investment too dangerous? Does the potential reward justify these specific risks? The pre-mortem analysis forces you to confront the downside with brutal honesty before you have committed a single dollar. It is the direct opposite of the sales pitch from a financial advisor, which is designed to highlight the upside and minimize the risks. This tool is your internal fiduciary, your devil's advocate, ensuring that you make decisions with your eyes wide open. The antithesis of the investor acting as their own fiduciary is the one who succumbs to what is known as get-even-itis. This is the person who holds on to a losing investment, not because of a rational analysis of its future prospects, but out of a desperate emotional need to make their money back. Let's say this investor bought a stock at $100 per share and it has now fallen to $40. Their original thesis for buying the stock is long dead. The company is losing market share, its profits are declining, and its management team has made a series of blunders. A rational, fiduciary analysis would conclude that the best course of action is to sell, take the loss, and redeploy the remaining capital into a more promising opportunity. But our investor can't bring themselves to do it. Selling would mean admitting a $60 per share mistake. It would make the loss real. So, they hold on, telling themselves, "I'll just wait until it gets back to $100 and then I'll sell." They are no longer investing based on fundamentals. They are investing based on hope and ego. They might even engage in the destructive behavior of averaging down, buying more of the failing stock at $40, thinking it will lower their average cost basis. They are throwing good money after bad, tying up their precious capital in a failing enterprise, simply because they cannot accept the psychological pain of admitting they were wrong. This emotional attachment, this failure of personal fiduciary duty, is one of the most common and most certain paths to the permanent destruction of wealth. They are letting their past mistakes dictate their future actions, a cardinal sin in the world of successful investing. The direct financial connection of the fiduciary pillar is the paramount importance of capital preservation. The first rule of a fiduciary is to protect the principal. The first rule of Buffett's investing is rule number 1, never lose money. Rule number 2, never forget rule number 1. This isn't about avoiding all risk. It's about avoiding the risk of a large, permanent loss of capital. The mathematics of loss are unforgiving. If your portfolio falls by 10%, you need an 11% gain to get back to even. If your portfolio falls by 25%, you need a 33% gain. But if your portfolio falls by 50%, you need a 100% gain, a full double, just to get back to where you started. A catastrophic loss is exponentially harder to recover from. Let's compare two investors, each with $100,000. Investor A is our get-even-itis sufferer. He holds onto a losing stock that falls 80%, from $100,000 down to $20,000. To get back to his starting point, he now needs his remaining capital to increase by 400%. The odds of this are astronomically low. He has effectively been knocked out of the game of compounding. Investor B acts as her own fiduciary. She uses a pre-mortem analysis, recognizes the deteriorating fundamentals of the same stock when it has only fallen 20% to $80,000, and makes the tough but disciplined decision to sell. She takes the $20,000 loss and preserves her remaining $80,000 of capital. She then redeploys that $80,000 into a solid, growing business. To get back to her original $100,000, she only needs a 25% gain, a far more achievable target. By acting as a ruthless fiduciary for her own money, she has preserved her ability to compound her capital into the future. She has survived to invest another day. This disciplined approach to risk management and capital preservation, born from a deep sense of personal fiduciary duty, is the ultimate financial advantage. It is the bedrock upon which all lasting fortunes are built, far from the reach of the barbers who are only too happy to give you a haircut that goes right down to the scalp. You have just invested a significant amount of your most valuable asset, your time, to rewire the very foundation of your financial thinking. You've moved beyond the simple notion of just avoiding fees and have absorbed a complete mental toolkit for financial self-reliance. You now understand that analyzing incentives is your shield, that simplicity is your sword, that doing your own work is your fortress, that inactivity is your secret weapon, and that a personal fiduciary duty is your unbreakable moral compass. This is not just information. It is a profound operational upgrade for your mind. You now possess a framework that separates the 1% of successful, independent thinkers from the 99% who are perpetually sheared by the financial industry. But it is crucial to understand that what you have just mastered, as powerful as it is a single crucial node in a much larger network of mental models that Warren Buffett uses to navigate the world. His system of thought is not a linear checklist, it is an interconnected lattice where each model supports and strengthens the others. The principle of avoiding the barber is powerful, but its true potential is only unlocked when it is connected to his models for understanding competitive moats, for calculating intrinsic value, for thinking about probabilities, and for managing human psychology. You have built a powerful engine, but to truly go anywhere, it must be connected to a chassis, a transmission, and a steering wheel. Right now, on your screen is a suggestion for what to watch next. Do not view it as a random video, see it for what it is, the next piece of the map. It is the potential missing link, the piece of the puzzle that might just connect the principles you've learned today to the next level of mastery. It could be the model that explains how to find the wonderful businesses you're supposed to hold forever, or the psychological trick to staying calm when the market is in a panic. The journey of transforming yourself into a truly independent financial thinker is a process of assembling this complete mental arsenal, piece by piece. The masses will click away now, satisfied with what they've learned. But those who are serious, those who are truly committed to a future of financial sovereignty, understand that this is not an endpoint, but a vital waypoint on a much longer and more rewarding journey. The choice is yours. Is this a moment of temporary inspiration, or is it the next step in your permanent evolution as an investor? Complete your arsenal. Continue the ascent. Click and discover the next piece.